Hey, what's up? How are you? Today we're going to be talking about the tax benefits of owning a home and what sort of benefits and risks you take on by assuming the responsibility of home ownership. All right. So if you could please smack that like button and let me know about what you think about this video. I would really appreciate it. All right. So first of all, why should you listen to me? I'm just a guy on YouTube. There's no reason to listen to me. Well, I am a licensed real estate agent and realtor working out of Miami, Florida. And Miami, Florida right now is one of the hottest markets in the country. And it's just insane what we're seeing going on down here. So I know a thing or two about real estate. I'm also a tax preparer, and I have been for about 2 years. I actually got my start in tax preparation just out of college, and I'm in the process of getting my enrolled agent certification. Not really certification, but it's kind of tricky what label to give that. But it's a process that you go through with the IRS that allows you to represent high level cases and clients in front of them. Very cool and very interesting if you're into that. But I know a thing or two about taxes. So I want to talk with you guys to go over some misconceptions, some benefits that you might not know about, and kind of what you need to know in order to take these benefits and be able to implement them in your own life. All right. So while I'm happy to talk here about these specific tax rules and how they might affect you, please don't just listen to me. I have no way of knowing what financial or tax situation you are in. So please consult your tax professional before making any tax decision. Now, I want to cover 3 points. And the first one is going to be the benefits of paying your taxes and how that will help you buy your home. Number 2 is going to be the benefits of having a mortgage and paying real estate taxes. It actually can help you. And number 3, the sale of your primary residence and how to avoid paying taxes on that money, on that property. All right. So now that we're starting up, I do want to hit that first point, which is the tax basics. So we kind of know what we're talking about. We're on the same page, right? Most individuals have to file a tax return under a 1040 in most cases. And that's what we're going to base everything off of because, things can get pretty complicated, but we're just trying to keep things simple. The way that taxes work is that they will either tax your earned income, which is any money from a W-2 job or self-employment income. But without that jargon, it's just money that you earned for goods or services that you provided. Next, the IRS. Oh, and actually, the IRS doesn't care where you got it or if it's illegal or not. They just want their money. You can report whatever. As long as you report it, the IRS is more than happy to take that money and collect taxes from it. Which is kind of funny that you would assume that they're part of the federal government. They want to know everything's legal. They don't care. It's the craziest thing. They don't care if that trade that you're a part of is illegal. They want to collect taxes on that. Now, that's not, you take that as it is. It's just an interesting little tidbit. All right. And the second form of income is unearned income, which could come from investments you've made or assets you've sold. And both types of income are taxed differently. And each subsect of each type of income has its own rules. This is important to know, but there's just too much to talk about here. So let's leave it that as it is and continue with more basics for tax returns. All right. People who are single, married filing jointly, and head of household fit most situations, and they get different levels of standard deduction. What is a standard deduction? It's the first portion of your income that the government will not touch before going after you for taxes. It is a section of your income that is wholly yours and you don't have to pay any taxes on that income. After the Tax Cuts and Jobs Act a few years ago, that standard deduction was raised from about $6,000 for single individuals to around $12,000 for single individuals. That's pretty great. That's awesome. That means that first $12,000 of your money, they're not touching, right? For people filing as a head of household, that number is actually more around 18,000. And for people married filing jointly, it's 24,000, just about. We're not going to get into more of the kind of jargon and like minutia of tax law because it is dense. It is a lot to talk about. So we're just going to leave it at that. But I want you to keep in mind your standard deduction and that it is the first portion of your income that the IRS will not tax, and that it is about $12,000 if you're a single individual, $24,000 if you're married, filing joint. And two, that there's different forms of income that is taxed by the government, that are taxed by the government, and they're taxed differently. So they're not going to be taxed the same. So keep those two things in mind: standard deduction, types of income tax. So now let's get into it. All right. Number one, the benefits of paying your taxes and how it will help you buy a home. All right. During my time as a tax professional, I've heard the same story over and over again. And that is that people want to deduct the maximum amount that is allowed by the IRS, the Internal Revenue Service, so that they don't have to pay taxes. The way this works is that if your income source allows for deductions, you can kind of exclude those expenses from your income, right? So you're not taxing that money because technically it was used for the maintenance for that source of income. So it was never really yours. So you could write off these expenses and that would bring down your taxable income. Now, that brings down your gross income as well, right? Because if you're writing it off, that sum of money was never yours, right? So you could have made a lot of money last year and included a lot of deductions, a lot of expenses, and as a result, you're just dropping your income lower and lower in order to pay less taxes. I don't think that's very smart. And the banks don't either. So if you do that and then the bank sees that tax return, because they ask for 2 years and the bank sees that tax return, they're going to ask you, how can we lend you $180,000, $350,000, whatever, when you earn nothing on paper? You earn rarely anything. How can we feel comfortable in lending you money when all you made from your $1 million business was $25,000? You know, it's kind of nonsense thinking where you're just trying to avoid paying taxes, but that's very short term thinking. If you want to build a basis for you to be able to benefit from these loan types that exist out there and these loan products, you need some income. You need to be able to report income, and you got to be able to have the tax returns to prove it and the bank statements to prove it. Tax returns are super important, and you need to make sure they're done right. Lenders use your taxes as a proof of income and proof of consistency and financial responsibility, right? So in order to show that a lender that you've got the right stuff, you need a nice and beefy tax filing and responsible tax payments in order to show the bank you're ready and that you can handle the situation, you can handle the loan. That brings us to point number 2, which is the benefits of having a mortgage and paying real estate taxes. Now, this is actually a benefit to taxpayers where you might save some money, but it's misleading. I hear from other agents and other other real estate professionals all the time about how you can write off the amount that you paid for your property taxes and your mortgage interest payments. And that is true, but it's not as helpful as it used to be. The Tax Cuts and Jobs Act, which we mentioned earlier, that raised the standard deduction, affected the use of this. So you can write off these interest payments and these property taxes if you itemize your deduction. Now, an itemized deduction is kind of the opposite part of the standard deduction that we talked about earlier. The standard deduction allows you to write off either $12,000 if you're single, $24,000 roughly if you're married, filing jointly, and roughly $18,000 if you're head of household. This itemized deduction lets you write off more, but you have to surpass the amount that's offered to you by the standard deduction. So if you want to write off more than that $12,000, $24,000, $18,000, you're going to need to show those expenses and show that those expenses were higher and greater than $12,000, $18,000, $24,000, which most times it's not, right? So you can include that in your tax filing, but it's not going to help you for squat unless you, for a fact, had greater expenses than $24,000, $12,000, or $18,000. And most of the time, that's not the case. This is going to be a great benefit for you down the road. If you start investing your money wisely in real estate or in however other manner that you want to invest it, this can help you greatly. This can be a great help to you, especially as you get into nicer, bigger houses. But if you're starting off and this is your first home, it's not going to help you. More likely than not, it's not going to help you. That doesn't mean it will never help you, but just not right now. So if you hear that, kind of hook phrase coming from a real estate agent or any real estate professional, they don't know what they're talking about with taxes. That's a completely different monster. Okay, so let's take a look at how this works on an actual tax return. You have your itemized deductions, which is where that would go. And here you can include certain things like health insurance premiums, right? The amount of medical miles that you have to drive for things related to medicine. Your income tax, real estate taxes. This is where you include the property taxes that you paid on your personal property and your home mortgage interest payments as well. That has to reach a level higher than either 12,000, 18,000, or 24,000, depending on your filing status, and that's a rough number. It's hard. It's hard to get up there, and just to show you, like, let's say you're paying a mortgage interest of about $6,000. No, let's even up it, right? Let's go $8,000. And real estate property taxes of $3,000. Miami, let's say $4,000. And then let's look at it. Right here, right? Standard deduction or itemized deduction, $18,650. That's the in this case, which is this person, this Ponderosa Pine test person that we've created, is a head of household filing status. So her standard deduction is $18,650. She does not reach the threshold to qualify for the itemized deduction. So it doesn't benefit her. And this tax benefit, which could help you down the road, might not help you. So bear that in mind, and don't let some real estate professional tell you, or real estate shark tell you, that you could benefit from that when you probably can't yet. All right, so we're at the third section now. The sale of your primary residence and how to avoid paying taxes on that property. It's actually a lot simpler than it sounds, and you really don't have to do much. But it's important that you work with a tax professional who knows what they're doing and knows how to apply this law. The IRS code allows you to write off the sale of a real estate transaction for your primary home, which is insanely great. All right. Since real estate sales is considered a capital gain or loss from assets, it is subject to capital gains tax, which can be up to 20%, which is insane. If you made $250,000 on the sale of a house, you're looking at around $45,000, give or take, of taxes that you have to pay at the top 20% tax rate. That's a lot, and it's horrible to think that you would live in a house for so long. It just happens to accrue in value, and then you sell it and have to pay all this money. You're left with nothing at the end. But that's not the case, right? The IRS has a section that actually protects you from that and means that you get to keep the majority of those earnings for the sale of your primary home. The only condition, it has to be your primary home. So there's going to be a certain test that you have to meet or qualify so that you can exclude that amount, but it is a sizable amount. For a single individual, you can exclude up to $250,000. And for a married filing joint, you can exclude up to $500,000. That's awesome. You can't beat that. And let's take a look at how this looks on the worksheet. So let's see if we can start filming. Start recording. All right. Here we go. And I got the actual worksheet that would be calculated with your tax return to see what exclusion you could apply towards your taxes. Let's take this case with our test subject, Miss Ponderosa Pine. She's a head of household, individual, and so her standard deduction is $18,650. But she had a home. She bought it a few years back for $250,000. It was her primary residence. Never rented it out. It was just where she lived. She needed it, and so last year she decided to sell it, and she sold it for a whopping $500,000. She made $250,000 from just owning a home. She had to pay closing costs. She had to pay a bunch of fees. I put in a rough number there, 15. It could be more. It usually is. But let's just do this for rough math. So she pays $15,000 for the closing expenses. That means the amount that she realized, the amount that she received was $485,000. But how much did she gain? For that, we need to know the basis. We need to use this number here, the $250,000 that she used. She got it for the purchase price originally, and subtract that from the new purchase price, the new sale price. So that would leave her with a net of $235,000. That's a lot of money. That's a good amount of money. And thankfully, since it's under that $250,000 exclusion that she applies for, the amount that she has to report as a taxable gain is $0. It's awesome. It's a great benefit that you have, especially as a homeowner. And this one, more than any of the other benefits, is, I think, reason enough to get your foot into real estate. This just, a lot of times you'll hear that a home is an investment, even if you're not investing in commercial real estate, or you're renting it out or anything like that. A home can be an investment because it starts to accrue value more so than other asset types. Like a car will depreciate immediately, and it's really difficult to find the right model or that will maintain value and that type of thing, unless you really know about cars and you're into the high level trading, all that. But for the average Joe, if you buy a Toyota, it's gonna depreciate. And if you buy a house, if you buy a condo, it's likely that it's gonna appreciate and keep that value that you've paid in, that money that you've paid in, is gonna follow the market and go up. So if it's a really safe way, if you know what you're doing, and if you run your numbers, it can be a really safe and profitable way to invest your money that you have to spend anyway because you're living somewhere. And any gain that you might realize from that is protected to an extent. So you're not gonna have to pay a bunch of taxes on this investment, whereas you would in other asset types, asset classes. I do want to start touching more on kind of real estate investing strategies and that kind of world. But these videos are mainly to show you how starting, even just as a homeowner, of one house, of your primary residence, can change your world. You know, studies have shown that just owning a home can change the outlook of a family, right? It creates more financial long-term stability. It creates more connectedness and pride in your community. And those are great things, especially for young families, young individuals. It's something that attaches you to your community in a very intimate, special way. So I love the idea of people getting started in real estate by getting their primary home first. If you want to start investing in real estate, amen, good for you, kudos, absolutely do it. We can talk more about that soon. But just getting that first home, your home, and making sure that it's a good deal, that you can afford it, that it's in a good area, that's gonna go up in value, that yada yada yada, can really, really change your life. But with that, I really appreciate you watching this video. Please give me a like, give me a follow, and I'm gonna cut to some drone footage because I got it. Let me know what you think, and peace.